The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Box with Karen Cho and myself, Steve Sedgwick, and these are your headlines. The Dow plunges and tech tumbles as President Trump rails yet again against the Federal Reserve, calling Chair Powell a major loser for not cutting rates faster. The greenback faces a confidence crisis as tariff worries hit the dollar demand, sending the greenback to a 3-year low.
Chinese battery maker CATL ups the ante, unveiling upgraded cells it claims offer even faster EV charging than rival BYD, giving 520 kilometers of range in just 5 minutes. Tesla shares sink 6% ahead of earnings due today, with one analyst calling it a code red moment for the company.
Morning, how are you?
Good morning, very well, thank you.
Good. If Trump's policies were doing so much good for the US economy, yeah? If it was going so well, here's a question for all of you, and for her. Why would we need rate cuts? Why would we need a more aggressive Federal Reserve if everything was going super duper, that the economy was going from strength to strength on growth, that the IIF hadn't just put out a piece in the last 24 hours saying actually now we think the US could go in some form of recession in the latter half of this year. If things were going so well from the tariffs and we were chucking in so much money into the United States and there was a couple of $1 billion a day coming in plus, why would we need rate cuts? Just asking for a friend.
The warning signs have already been flashing thanks to Liberation Day and then the pause. There's endless pause now on tariffs and whether anything is going to be negotiated. So I think the market, you've seen very aggressive moves to the downside. On top of it now, this layer around Jay Powell and again questioning whether his policy is correct. And, you know, as a journalist, we get to see some stories over and over again, not the same story, exactly the same story, with a little bit of a break in between. But we saw this first time round of the administration. The difference this time is that there's already been a rattled bond market for different factors around the fiscal spending we've seen in recent years, the tariff issue now, and of course now another layer on top around questioning Jay Powell's policy action here. So I've got to say it comes at a very difficult moment to have the same sort of pushback against the head of the Fed. So two different factors for markets. I think they've already been flashing warning signals, but what's going to get interesting this week away from just the index levels in the dollar will be the stock specific news as we look at earnings reaction as well. So there's different layers to this market, I think, where there are concerns.
Yeah. I mean, Tesla, at the moment, it's sell first and ask questions later from the shareholders on Tesla, which fell once again. Okay, let's go through. Are we going to do the Trump social piece? I'd quite like to. Oh, it's in this, is it? Okay, right, lovely. Okay, the Chicago Fed President, Austin Goolsbee, told CNBC he's in favor of a wait-and-see approach from the Federal Reserve. There you go, especially with uncertainty around Trump's so-called reciprocal tariffs.
I think our uncertainties at this moment, and why for me personally, when I hear Jeremy saying preemptive cuts, we're getting announced retaliation. We're talking about revisiting the tariffs in 90 days, and we don't know what the impact on the supply chain is going to be. So I think we want to be a little more the steady hand and trying to figure out the through line before we're jumping to action.
No, Goolsbee's got to be wrong. That can't be right. Announced retaliation, but hey, what does he say here? We don't know what the impact on the supply chain is going to be, so I think we want to be a little bit more of a steady hand, trying to figure it through before we jump in. No. The president, Mr. Goolsbee, is telling you to jump in. He already knows the results of these. He must know better than you. You're a central banker for many years. Surely you should act now before you see the evidence of what happens with the tariffs.
Did you see Rosengren's comments?
No,
the former Boston Fed president.
What did
he was saying on a social media post on X, saying unless the goal is to make the US trade like a third world economy, threatening the Federal Reserve independence only makes the US less attractive to foreign investors. I mean, that is quite something, as we were talking about US exceptionalism last year, to now be talking about whether we're trying to push the US into a third world country, like trading partner.
I don't even know if we use the term third world anymore. I mean, it's emerging economy, developing. I don't think we're supposed to use third world anymore, but I take on board his points anyway.
Yeah.
But hang on a second. Oh, I get it. This is part of a cunning plan. Get the dollar down as aggressively as you can in order to make your goods cheaper for the rest of the world. Yeah, that's got to be it. Yeah,
well, the dollar is down.
Yeah, exactly. That's got to be the clever plan. The only problem is you buy way more stuff with the rest of the world. Ergo, that stuff's more expensive. Ergo, potentially, I don't know. According to my economics textbook, it's more inflationary. But hey, you knock yourself out on getting the dollar down, US.
Look at the US markets. You know, every other day now we seem to be getting fairly large swings, and we had another 1,000 points nearly to the downside on the Dow yesterday in terms of what it meant. Heading now for its worst April outing since 1932. That's right, not the Depression era comparison here is what we're talking about. Last time around was the level of the tariffs that we're talking about that were Depression era like. In terms of the performance, you can see right across the board the markets were down. Big moving names, United Health, Nvidia moving to the downside. For US technology names, it is the selling that is really around those Mag 7 stocks, and don't forget some of them will be reporting soon too. So concentration of focus there. Microsoft down heavily, Nvidia down 4.5%. So again, strip back there, and we're talking about homegrown competition from Huawei. That was another narrative that's damaged the fortunes of Nvidia. Apple sliding, Tesla. We were just talking in the headlines about Chinese technology, not BYD this time, which challenged Tesla's dominance the other week on its battery technology. Now it's CATL as well from the Chinese market. In terms of what we're seeing from Treasuries, the early picture this morning, as we again question the strength of the bond market, we've got yields pushing higher. We just had some relief in recent weeks, but again, we're now moving north on the long end, 4.43 in the 10-year, but it's at 30-year as we again sit just 8 basis points shy of 5%. The dollar has been a casualty. We've seen the rewind, we've seen the declines in the dollar. Very violent action is what we've witnessed in a very short space of time. Euro dollar, look at that level, 115.25 is where we've climbed to now in the morning session, up another tenth of a percent, as you can see. The sterling trade, pound 134. The dollar trade is weaker versus the Japanese yen, also sliding versus the Swissy. And to the Asian markets today, how they're tracking on the back of those Wall Street numbers yesterday, we're seeing much more contained. And this is again that story of diversification that keeps on happening where other markets are looking more attractive. Shanghai, Hong Kong perched a little firmer.
Yeah, I'm the only person left I know who still wants to go to the States this year.
Right. So you can
my wife
spend
said,
the great British
my
pound.
wife said, you sure we still want to go? Of course I still want to go. I love America.
Well, I was meant to be there this week.
Oh yeah, we got something else going on,
Yeah,
haven't we?
we've
We've got another little thing we're up to,
here.
but we'll tell people about that next week, shall we? The US president met with CEOs of 3 of the America's largest retailers, Walmart, Target and Home Depot, to discuss the impact of tariffs on prices, which I presume, it's all great, according to the administration. Anyway, following the meetings, the 3 companies issued near identical statements. Okay, what do they really think then? Saying they welcome the opportunity to share their insights and look forward to further dialogue. What does that mean? Anyway, Matt Orton is Chief Market Strategist at Raymond James Investment Management, joins us now. Matt, I've had my rant. I'm so sorry. I've bored the viewers again. Tell me I'm wrong. Tell me this is all part of a cunning plan.
Hey, good morning, Steve. Well, I wish I could say it's part of a cunning plan. It's really hard to discern. And that's what you're seeing play out real time in the markets. Investors don't know what's happening. And it's really this uncertainty, this pervasive uncertainty where we don't know what's happening on the macro level that's really starting to feed through with respect to corporate guidance. We're starting to worry about what that might do to consumers. And so there is a very negative effect. It's almost death by 1,000 cuts. We've been talking about tariffs for a long time. We finally got tariffs, which were worse than we expected. And now we're living through those effects. And so when I try to bring it all home to clients, because this is a very, very charged environment here and around the rest of the world. And what I really try and do is segregate how we feel about the policy, whatever side you might end up on, and really think through how do you build a portfolio looking out 12 months down the road that can be well diversified to help weather the storm, because it's too late to sell. I don't think investors should sell. But there are places you can hide out. There are ways you can diversify, whether that's through gold miners, looking at other emerging markets like India, leaning into secular growth trends in the market like cybersecurity, defense. There are places that you can go where there's less of a question mark with respect to earnings and less of a negative impact from the macro uncertainty that we're dealing with right now.
Matt, for all of our US audience who want to own US stocks, or our international audience who want to own stocks, we were told, it was skewed to the big tech names. Well, when I look at the Russell 2K down 25% from its record high, I look at the Dow Transports down nearly 28% from their record highs. I've got to be honest, I don't see any broad brush places to hide in US equities. And the bond market, from what Karen was just saying as well, with that 440 yield on the 10-year, I don't see anywhere to hide there particularly as well. Where else, if you want to own a broad brush portfolio, do you look?
Yeah, so I think broad brush doesn't mean owning the index itself. It really means being focused on the idiosyncratic risk that you're taking in your portfolio and leaning into those secular growth trends like I talked about. And so when we came into this year, I told clients diversification is going to come back. I didn't think it was going to come back or be as important as we've seen play out so far this year. But diversification means across geographies, it means across asset classes, and it means within sectors and industries. And so balancing out of US, looking across the rest of the world, European defense companies have been a great trade. I think buying that on weakness makes a lot of sense because there's durability to it. Looking at emerging markets, like I mentioned before, like in India, for example, where 2% or less of its GDP is tied up with respect to tariffs. And oh, by the way, the market just came out of a 15% valuation correction and earnings are starting to pick up again. That certainly seems fairly attractive where asset flows can start to pick up again. And then even when you look in the US, I would argue we've seen peak concentration. I don't think, especially given everything that's happening right now, we're ever going to get back to the levels of concentration, at least not in the short to medium term, for what we've seen before. But that doesn't mean that underneath the surface that there are very strong corporate stories that are working in this specific market. You look at gold miners, like I mentioned, those have been great areas to buy on weakness for the market. You look in healthcare, you might not want to own a United Health, but you look at what's happening with respect to Lilly. You look at what's happening with respect to some of the pharmaceutical distributors that actually benefit from inflation or tariffs that might be placed on some of the generic drugs that get imported to the US. Those are areas that you can hide. And dividend growers. Dividend growth has actually significantly outperformed the broader market. So that's what I mean by diversification within the overall market.
Matt, in the meantime, we're going to have to get through some earnings this week, and some of those will be Mag 7 stocks for the likes of Tesla, Alphabet. Some will be defense names. What do you think we're likely to see? Because we know there's been distortion of a pull forward effect around the tariffs for some industries, some companies. But what do you think, by and large, we're going to see in terms of some of these big name stocks?
Yeah, Karen, that's a great question. A lot of the earnings are getting overshadowed by all of the macro noise. But what I think is most important with a lot of these big mega cap tech names that are reporting, it's going to be guidance. And within the guidance, I think you want to really pay attention to what are they doing with respect to the AI investments? Are they continuing to make those or are they pulling back? I think that can be telling about their perception of demand across the overall economy. And I think in addition to that, like an Alphabet that reports later this week, being really tuned into what's happening with respect to their ad spending. There's issues with respect to some of the Chinese companies with cheap goods coming into the US that are pulling back. Are people still spending on YouTube advertising? That's going to give us a really good signal with respect to just where the broader economy might stand, at least in the short term, or how much damage uncertainty is going to cause to what had been really, really strong growth stories. Longer term, I think there are good buying opportunities, but I don't want to be wading into any of these names in the near term right now.
Matt, some of these stocks are interest rate sensitive, and typically when borrowing costs went down, these stocks went up. And we just have heard from the likes of the president saying, look, rates should be lower from here. The market's priced in 100 basis points so far this year. But now the question is lingering around the independence of the Fed as Trump pushes back against the central bank. Where do you think interest rates are going from here? Are we going lower because we're heading towards a recession?
Yeah, I think the curve's going to continue to steepen, Karen. I think the market's going to continue to speculate what's going to happen on the front end of the curve. And I do think it's likely we're going to see Fed cuts. I think the market's a little bit offsides, though, and there's going to be some adjustment that needs to happen because I can't see, recession's not my base case. I don't see the Fed cutting more than 2 times because I just don't think they need to based on what we know now and based on the assumption we start to get some sort of negotiation with respect to tariffs. But the back end of the curve is pricing in inflation expectations. That is very, very real. And again, when you go back to earnings season, looking to what companies are able to pass on to the consumer, looking at what's happening with respect to their input prices that they're going to guide us to, that's going to be really important to see how much further perhaps the back end of the curve can go, playing out that inflationary story in the overall economic narrative.
I've had brushes with Jay Powell over the years. I remember at one conference he just completely ignored all my questions and carried on walking past. But I respect the man intensely. I respect his independence. I respect the independence of the Federal Reserve. Is he still the right man for the job, or actually is the president right? He's too late and should be gone.
No, he's not too late. Powell has done a commendable job, even through some of the issues we had with respect to transitory and perhaps, or not perhaps, definitely being late to that. But he has been very, very measured. And the Fed has been incredibly consistent with respect to the guidance they have given us and how they're going to act. That is really important to carry forward. And for all of the bluster that Trump is giving, the fact that you haven't heard Besson kind of corroborate what Trump is saying. Up until the weekend, you never really heard Hassett say anything about it. And still, it's been kind of in passing. Congress has come out in support of the independence of the Fed as well. Republican senators have been speaking up too. So I think a lot of this is bluster. And honestly, if I'm Trump, at the end of the day, the Fed kind of gives you cover to some of your policies. You can blame the Fed for your issues. They didn't lower rates, fine. Blame it on the Fed for what happens to the economy. So he's taking away, I guess, a chip if this tariff policy doesn't play out the way he wants it to, which it's not really doing right now. So I don't really get it, but I don't think that bedrock of the economy is going to change. And if it does, he's going to pay the price for what he's trying to achieve with looser financial conditions. And I think a lot of the inner circle of his cabinet are showing him that right now.
Very good, Matt. Lovely to speak to you. I don't know what time it is where you are, but I'm sure it's stunningly early or stunningly late if you're a party animal. Thanks very much indeed for joining us. Matt Orton, Chief Market Strategist at Raymond James Investment Management. Something tells me that Matt isn't a party animal, that he's too studious for that. And for more on what a depreciating greenback means for economies around the world and why emerging market central banks may be forced to intervene, head online. There's a great piece there. In fact, there's many great pieces at CNBC.com.
Coming up on the show, Italy and the US build up trade momentum with Prime Minister Giorgia Meloni visiting Washington, while US Vice President JD Vance heads to Rome. Plus, L'Oreal reports a better than expected first quarter sales growth, but the CEO flags challenging conditions in the US. We'll bring you more this hour. And we'll discuss the impact of US tariffs on Canada, as well as the country's opportunities for closer ties with Europe, with the Canadian Economy Minister Christine Fréchette. Don't miss that first on CNBC interview, 8:30 BST.
Yeah, plus on an exciting programming note, CNBC Europe is getting a makeover. That's CNBC Europe, not me, by the way, with a brand new studio, unfortunately, and a new programming grid, which means starting Monday you can catch Sylvia Morrow leading our European coverage. 6 a.m. BST, Europe Early Edition. I've seen a sneak preview. It's a great show. And Squawk Box with myself and Karen. We're getting a third anchor, Juliana Tattlebaum. That's from 7 BST. Tributes have poured in for Pope Francis, who died on Monday at the age of 88 after a stroke led to irreversible heart failure. The pontiff's body is likely to be moved to St. Peter's Basilica tomorrow for mourners to pay their respects. NBC News' Molly Hunter was at the Vatican yesterday and filed this report.
As soon as the news of Pope Francis's death was announced, cardinals from around the world have started making their way here to Vatican City. Now, tomorrow will be the first meeting of cardinals. Not all the cardinals will have made their way to town by then, but the first meeting of the cardinals who are in town. And the papal funeral is expected to be held within 4 to 6 days. And on the agenda in the next couple of days will be the exact date of that funeral. You can bet that will be on the agenda in the meeting tomorrow. Now, as far as the funeral details, Pope Francis during his life designed a lot of them. This is not going to be a huge state splashy funeral. This will be a pared back funeral, a simpler funeral, a streamlined funeral for a pastor, something more humble than what we've seen in the past. And he's made some of the changes. For example, tonight, Francis's body was placed in a single coffin made of wood and zinc, not the traditional trio of coffins of his predecessor. Now, he could be moved actually as early as Wednesday to lie in state in St. Peter's Basilica. And another change, he will not be buried in the Vatican grottos. Instead, he's chosen a different basilica in Rome, Santa Maria Maggiore, a basilica in the center of Rome. It was very close to his heart. He visited often. And then the attention turns to electing a new pope, the secret, mysterious process known as a conclave. It will happen in 15 to 20 days from today, from the pope's death. And as the cardinals come into town, more and more general congregations will happen. There will be formal meetings and informal conversations as well. And then, of course, they're sealed inside the Sistine Chapel. Voting will begin. Black smoke, as we know, once the ballots are burned, means no pope. And white smoke means a new pope has been chosen.
US Vice President J.D. Vance was in Rome over the weekend, meeting with Italian Prime Minister Giorgia Meloni after her visit to Washington, D.C., followed by Pope Francis on Sunday. The Vice President has since arrived in India, where he met Prime Minister Narendra Modi, with the two hailing progress on potential trade deals. Now, US President Donald Trump has hosted Italian Prime Minister Meloni in the Oval Office on Thursday, with Trump saying he is in no rush to end his tariff policies. He also accepted Meloni's invitation to visit Rome, while the White House said they could meet other European leaders as part of such a trip. Meloni vowed to keep working with the US.
Even if we have some problems, between the two shores of the Atlantic, it is the time that we try to sit down and find solutions. So I want to thank President Trump for having accepted an invitation to pay an official visit to Rome in the near future, and consider the possibility in that occasion to meet also with Europe. The goal for me is to make the West great again. Okay, and I think we can do it together.
We can.
We will keep on work on that.
Well, Sylvia joins us with more. Sylvia, let's just pull some of these threads together, because I think what the market is looking for is any progress on a trade deal anywhere that would give them some clarity about further deals being forthcoming.
And that's why I would split this trip into two dynamics: the appearances and the detail, the substance. When it comes to the appearances, it was a successful meeting for Prime Minister Giorgia Meloni, a lot of warm words from the President Donald Trump, and he also went as far as saying that there will be a trade deal 100% with the EU. They want to make one very much. But then this brings me to my other side of this equation, which is the lack of substance in this meeting. We don't know where the United States actually stands when it comes to trade conversations with the EU. What do they want to achieve? But nonetheless, we are witnessing all of this diplomatic effort, whether that's the Italians, the broader EU, or the UK, everyone trying to have conversations with the White House at this stage to figure out how they can overcome the impasses around tariffs. Let's see how these conversations will unfold. But for the markets, for our viewers out there, the question is that we still don't have detail in terms of how the EU and the US might overcome these differences, if they will at all.
Giorgia Meloni is one of the top 3 or 4 politicians in Europe, no doubt about it. But she doesn't speak for the Commission. And sometimes Italy historically has been an outlier to the Commission, sometimes it's been right at the centre. At the moment, we're not quite sure where Meloni is. Let's be honest about it. We thought she was going to be an outlier, but actually she's kind of gone along with a lot of Brussels policy. Now we're not so sure as well. What she can do is obviously, offer the trips to Trump, flatter Trump as well. We know he likes flattery as well. Like, the King Charles visit here in the UK all worked very nicely, we think, as well. But she can't change EU policy regarding a whole host of issues single-handedly as well. Is this just, yes, it looks very nice on the surface, but at the end of the day, the trade war between Europe and the US will actually happen?
It's a very good point you're raising, but the difference this time around is that she actually coordinated what she was going to say in Washington with the President of the European Commission. There were phone calls, and I got confirmation from a spokesperson for the European Commission. There were phone calls between Ursula von der Leyen and Giorgia Meloni
Unlike
ahead
when
of
Orban
this trip.
goes off on one of his trips to Moscow.
For instance, and of course that is helpful. So she coordinated her response going into Washington, D.C., which is helpful. Of course, she has the Italian interests in mind, but when it comes to trade, she's very much aware that trade policy is an EU matter. It's for the European Commission to actually negotiate. So, of course, it was very clever to go to D.C. with, to some extent, with a bit of a mandate, to some extent, from the European institutions in terms of what they want to achieve and what it would be helpful, really, in the trade negotiations with the US.
So one of the points that we've been looking at is whether the administration will go through every single line item with every single country. Part of me wonders whether they'll just go for the headline act. And to my point, that one thing we know about India, well, one thing I know about India, is that the Americans have been really challenged over the years to get their retailers into the Indian market because the borders have been so high. And it seems as though one of the big points of negotiation will be allowing the likes of Amazon and other big American retailers to get access to that Indian market. So we cast it over to Europe. And I wonder whether it's the same thing here, whether some of the headline items might be the points of negotiation mainly, and other things may fall by the wayside in the bid trying to get things done, given there's so many nations.
It is a possibility, but here we are once again, we just don't have that clarity. We don't know exactly what is actually being featured in these conversations between the US and the EU. We know that the Europeans are preparing for the eventuality to tariff digital services, to look at that aspect of the conversations as a way to retaliate further down the line. Do they want to do it? No. But are they getting ready to potentially doing it? Yes. The other point I would actually raise from the conversations in DC between Italy and obviously Donald Trump is actually the comment from Giorgia Meloni in terms of energy, suggesting indeed that we are willing to look at that as a way to find a compromise with the Americans.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.